As we close out the first quarter of 2022, wow, what a crazy quarter. We've got bond yields showing a recession to come. It looks like drill baby drill in Washington again. Two words we haven't seen in the housing market in a long time have popped up again: price reduction. And a supply constraint that is a very odd one that we probably haven't had before in the housing market. People are in love with their current mortgage. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. I hope you're having a great week. So, as you've probably heard on the news, and we talked about this a few weeks ago, Treasury bond yields are indeed inverted. They are almost upside down with, as we speak, it's the middle of the day on Thursday today. The 2-year is trading just about 1 basis point away from the 10-year, with the current 5-year Treasury note higher than the 10-year and just about the same level as the 30-year. And this is certainly a sign of a recession to come. I'm going to define a recession. A recession is 2 consecutive quarters of negative growth. You actually don't know you're in a recession until you look back and notice that you're in a recession. But the question here is, how deep is a recession? Because you could have growth coming out of something that we just came out of being very high, a little bit artificial, and then 2 slower quarters coming off that might not be a deep recession, but it looks like things are certainly slowing down. And the president today in Washington decided to tap these strategic oil reserves to 1 million barrels a day. That is good for the short term, but what I think is more important for the long term is he was also talking a lot about alternative energy, calling it clean energy. So I'm going to go and call oil and gas dirty energy because everything has the opposite. And it looks like they're going to step up their initiative to get us away from oil as a national security issue, as I've been mentioning. And I think they should also take that cue and start growing more food in this country. As we know, whenever you fly across the country, 80% of it seems barren, and a lot of it seems like it's good for farming. So maybe we should take the cue from the oil reserve tapping to tap into our own farmers. And from what I remember, at one point in history, they were paid not to grow crops. I think it's time to pay farmers to grow crops again, because it looks like clean energy is going to be ramping up out of necessity. Okay, this price reduction word that we have not heard in a long time, this is a very interesting one. It is not the norm. Let me just make that clear. But I have seen it in the last week on a few different properties when I'm searching around, and I have not seen that word price reduction in a very long time. Again, it's not the norm, but it is starting to happen. We are indeed going through a great reset right now of the housing market based on the interest rates that have essentially put a shock to the system. They've gone up so fast. They have not gone up this fast since 1987, what they've done in the last 3 months. This is, of course, going to put a shock into the system. And this great reset, according to new interest rates, is going to take about 2 months, is my guess, maybe up to 3, to work through the system and to normalize and recalibrate the buyers' and sellers' expectations for that matter. So we will see this new environment, the great reset in the housing market, take place over the next few months. And I mentioned in the beginning, mortgage love. I think that most folks that got their mortgage in the last few years are in love with it, given where mortgages are today. And as I just mentioned, rates have not gone up this fast in a few decades, 1987 for that matter. So the buyer is now dealing with 3 constraints: record high prices, essentially, all-time low in housing supply, and of course, higher but not yet high interest rates. Now, one of the reasons there's an all-time low in supply is because the 2010s, the last decade, there was less homes built in that decade in relation to what's needed to be built since the end of World War II. Here we are, a few years into the next decade, and now we are seeing this housing crisis, which also is going to be more constrained because people do not want to get rid of their mortgage that they got in the high 1s, low 2s on a 15-year fixed, high 2s, low 3s on a 30-year fixed. That right there in and of itself is going to be the hardest thing to get somebody, in my opinion, and to move out of their home when it's not a necessitative move, meaning their circumstances changed, their job has changed, or they're going to retire and move. Something is going to happen that's going to trigger a move, but it's not going to be a luxury move down the street to a house that they really liked when they're walking their dog every night. So right now, this housing supply constraint is going to indeed support home values. They might come down a little where they're a little bit inflated, but in general, housing is safe in terms of value because there aren't any. So there's a scarcity right now when it comes to housing, a big one, and there's going to be a bigger scarcity to try to get folks who may not love their house or their home, but they love their mortgage, so they're going to like their house now a lot more than they would because of the financing that is indeed tied to it. And on a side note, rent, as I saw a stat yesterday, is basically out of control. It's up 15% year over year, which is a incredible inflation rate. I don't think that can keep up, but I believe that rent will keep going up because of the general scarcity in housing that is indeed out there. And I dare to say this, maybe a little bit early, but if this keeps up for a little while, this actually might turn into a buyer's market depending on how long rates stay at these levels because of that shock. So when shock happens, reactions are unpredictable and you just never know. So we could, in a weird place here very shortly, even though there's not a lot of supply, we could turn into a buyer's market on anybody who wants to sell. Interesting thought, interesting theory. We will indeed see how this shakes out. And we will see tomorrow, Friday, the 1st of April, the jobs report for the month of March. A little surprised they're actually releasing it on the first Friday, on the first day of the month being a Friday. They usually wait to give those numbers out. So I bet you we'll get some heavy revisions to whatever numbers that we get tomorrow, which I believe Wall Street is predicting about a little bit less than 500,000 jobs created for the month of March with a steady unemployment rate. But as I mentioned, jobs is one of the four horsemen of the economy, and we'll touch on them a little bit more next week, but we will see what the numbers look like tomorrow. Okay, everybody, that's my show for this week. I hope you have a great rest of the week. And of course, if you need anything on your mortgage or anything real estate related, please don't hesitate to reach out to me. Thank you so much for watching. Again, have a great week.